Welcome to the weekly Titans of Industry show. We've had a real estate special with Mr. Buck Joffrey last week. It was a great show, and a European political crisis update, and a gold show with the legendary Bob Moriarty. And today I have a very important show with a guest that is perfect for this time of the year. And you know, it took me forever to realize that specialists know many loopholes that can save you big money, but because we're so conditioned to a specific way of thinking, we miss out on the secret sauce so many times. And I'm still amazed at how most people, and myself included, forget to research and dig in more. And today's guest is a walking encyclopedia. I mean, Jordan Goodman is a financial expert in every sense of the word. He is, he's a best-selling author. He goes on Fox Business, on CNN, CNBC, CBS. He wrote many books, and I'm thrilled to have him on today. Jordan, how are you?
Great to be with you, Lior. Appreciate it.
It's true that the Fed is raising rates. But inflation is rising as well. So in the real world, you're not really making any money on bonds right now. Our team at Wealth Research Group, we've looked at 53 high yield stocks, and we've got 2 free PDF reports on the website on 3 of the best companies we found for 8% yields. I call them income champions. And we've covered private lending and real estate as viable ways of generating yield. But I know you've got some incredible value here. This is simply a horror show for investors and retirees banking on yield. What's the solution, Jordan?
Well, you're right. People who have money, there's about $10 trillion with a T, $10 trillion sitting in savings accounts, money market funds, treasury bills, CDs, pretty much earning zero at a time when inflation is starting to pick up. And so you know in advance you're going to earn zero. So that's not a good investment strategy at all. So the question is, what do you do with your money to earn a decent yield in this economy where you don't have your principal at risk? So something that I'm involved in, which I think could be helpful to a lot of your listeners, are called commercial real estate income funds. And there's a website for that, commercialrealestateincomefunds.com. It's a way of getting an 8% yield, annual yield, paid monthly checks, which you can either take or reinvest if you like. Minimum hold time, 18 months. And you can hold it for as long as 10 years. No commissions whatsoever, so 100% of what you invest goes into these things and gets the 8%. Minimum investment, $5,000. So it's not bad at all for most people to get into it. So what they do is they are lending money to short-term commercial real estate projects, typically 1 year, and they use it to renovate or improve themselves. And the concept they use is what's called forced appreciation. They're making the value of the property higher, not related at all to what's happening in that real estate market. They're not waiting for appreciation to kind of bail you out in various ways. And then once the project is done, you, the shareholder, get a piece of the profits when it's sold at a profit as well. So you get the 8% plus profits, what they call profit sharing, on a quarterly basis. Typically, depending on how many projects are sold during that particular quarter, it might be another 1 or 2 points. So it could be a total of 9 or 10 points on the whole thing, in very, very safe. And it doesn't have any market fluctuation, doesn't trade. And therefore, unlike some real estate stocks may be good, but they could be up and down based on what's happening with real estate. I'll give you an example, Lior, if this would help, of the kind of project that they do. Would that be helpful?
Yes, and I gotta say, I love this because it's outside of Wall Street.
Correct.
And what I also love about it, it's illiquid. So you don't have the temptation to trade in and out of this every day. It's okay.
18 months. You could, after that, you can get your money anytime, but most people keep it in there for years. Because here your money is compounding at 8% with no commissions. And in a 0% world, 8% is pretty good. So let me just give you 2 examples of the kind of projects that they do. There was a guy had a big house in a university town, I think it was Boulder, Colorado, and he was renting it out to 2 students. He got a loan from this fund, and it took him a year, but he renovated the house and made it into 4 apartments, 4 doors, 4 bathrooms, 4 kitchens. So the same house is now worth 50 to 75% more than it was a year ago, because the income just doubled. The cash flow just doubled from the same property. So the guy is not going to default on this debt because he knows once the project's done, it's going to be worth a lot more. Okay, so this is what I call forced appreciation. It was not based on what was happening in the Boulder real estate market. The thing was going to go up in value dramatically no matter what happened because he just doubled his rental income. Another example, they had a big house that was one elderly person was in there. They bought the house, renovated it, and made it into an assisted living place where there were 6 elderly people in like a nurse's station. So now they're getting 6 rents instead of 1 from the same house. You see what I mean? So that's what they're doing is forced appreciation. And it makes a huge difference because then once it's done, the cash flow is much more than it was before. They can sell it at a profit, a certain times cash flow. And you as the shareholder would be in a completely passive situation, earn a piece of that profit as well as getting 8%. It's called a preference yield, meaning the investors get 8% before the managers of the fund get anything. So there to me is a very simple solution. And so again, I gave you the website, commercialrealestateincomefunds.com. They've also got a phone number as well, which is 888-444-2102. And they're, I'm just giving you a way to earn 8% instead of 0 in this world without having any market fluctuation or anything related to the stock market at all.
Sure. 2 questions arise here because this sound very legitimate, and I've seen many of the competitors that play, and this sounds very solid. What's the default rate?
0.01%. I mean, they've been doing this for about 35 years. Way less than 1%, half of 1%. The maximum, the maximum they lend against the property is 70% of the value of the property. So the developer always has at least 30%, if not more, skin in the game. So he has no reason to default because he knows once the project is done. These are people who've been doing projects for many, many years. They know once the project is done, it's going to be profitable. So they have no reason to default. It's just very, 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 very unlikely.
Okay, that's one question. The second question, and this is, I just want to make sure because listeners need to understand this. If you've got a minimum of $5,000, you can spread your loans on a few different projects and actually get a lot of diversification here.
In other words, the fund has like 30 or 40 different projects in it. So you're right. For the $5,000, you're not putting it all on one project. You might have 30 or 40, and they're rotating all the time because they're starting new ones are being finished. So it's a constantly rotating portfolio of projects. And you're right, your 5,000 is widely diversified. And by the way, diversified geographically, I think it's in 30 states right now. And it's also diversified by type. So they may have retail properties. We talked about student loan housing, assisted living, apartment buildings, medical offices. You're diversified by different product types as well as geographically. So there's a lot of safety built into it.
Okay, now that was amazing, but many people who are tuning in this week either have a mortgage on their house or know someone who has a mortgage on the house. And I was quite surprised after reading your book, which is an absolute must. It's called Master Your Debt, which is one of the number of best-selling books you authored. You wrote in there that you can pay off a 30-year mortgage in 5 to 7 years. And can you take center stage here and explain this?
So this is a strategy called mortgage equity optimization. All right. And yes, you're right. The bank will never tell you about this. The bank is very happy with the current situation, which is you keep your money in a checking account sitting there earning 0, and then you pay them for 30 years with all the interest upfront loaded, right? The first 10 to 15 years, you're paying almost no principal whatsoever. After 15 years, you might have paid 10% of the principal outstanding, the rest of it's interest. And then if you refinance, you just start a new 30-year clock all over again, right? So that's what the bank thinks works well. It works very well for the bank, but not you, the customer. So mortgage optimization completely reverses the tables, and now your money is working for you instead of the bank. What a unique idea. And there is a website related to all this as well, which is called truthinequity.com. So I'm just going to give you a very simple concept of how it works because, you have to kind of get into it. I'm just going to give you a very simple idea. So with a traditional system, again, your money is sitting in a checking account, earning nothing. You're paying the same payment for 30 years, interest all up front, right? So that's the traditional system. So What you're doing here is you're using what's called a home equity line of credit, which is called a HELOC, which is a liquid line against your house, typically a second mortgage. You take money in, you take it out, you can write checks on it, it's completely liquid. All right? So you keep your income, which would normally be sitting in the checking account, in the HELOC, and every day they do what's called average daily balance. You're moving your principal down at an accelerating rate. Just to give you a very simple example, say you had a $50,000 HELOC, and it was just open $1,000 mortgage. You write a $50,000 check on the HELOC towards the first. So now instead of owing $200, you owe $150, and you now owe $50 on the HELOC. And say you get $1,000 for a paycheck. Instead of keeping the $1,000 in your bank account earning nothing, you put the $1,000 on the HELOC, and instead of owing $50, you owe $49. Right? So you are earning interest on the amount you owe, which is $49,000 instead of $50. So you see how you moved your balance down a little bit? Does that make sense? So every doing that, and you're moving that balance down the HELOC over 6 months, 9 months, however long it takes, you pay that $50,000 HELOC down to zero. Then you do it again. You write another check on the HELOC for $50,000 towards your first. It was $150, now it's $100. You pay the HELOC off after some. You do it twice more. Your first is now paid off. You pay off the HELOC, and depending on the numbers, 5-6 years, you are completely mortgage free. What a difference that'll make for somebody who's 25 or 30 years old to have their mortgage paid off by 35 instead of 65 or something like that. You're saving tens of thousands of dollars in interest and literally 25 years off your mortgage. How about that?
Sure, you become this idea of using the home equity line for a frugal and disciplined strategy is exactly what people should do with the home equity line. And you're right, the banking system does not tell you this. I have a great friend who for years have been using the home equity line to do forced appreciation that you talked about in the first instance, which basically what he does is he takes the length of time that he has from the day that he signed the contract until the day he has to close. He goes in that inspection period, he adds another room. Then he takes out a home equity loan on a 3-bedroom house instead of a 2-bedroom house. That home equity line is now larger than his mortgage, and he can do what you just said. So this is an amazing idea, but in a 15-minute interview, obviously you don't get all the specifics on this. I'd love
just get from the general idea.
Yeah, I'd love for people to get in plugged with truthinequity.com. And do you also mention these strategies in one of your books? That will be very important for which one?
The book is called Master Your Debt. That's the book. I have a chapter called Mortgage Free in 5 to 7 Years. So you go to that website, truthinequity.com. They've got a lot of videos and so on. They have a personal profile that you fill in, and you put in your income, your expenses, your house, your mortgage, and all these different things. You say, okay, based on what you're doing today, it's going to take you 28 and a half years to pay off your mortgage. With the numbers you just gave us, using mortgage optimization, it'll be 5.3 years, whatever the numbers come out to be. And then they show you step by step how to do it. And I've just saved your listeners tens of thousands of dollars and 25 years off their mortgage.
Now, Jordan, this is huge. And just so everyone's aware, nor me nor Jordan have any any dog in the fight and all this. This is content that is just to give it a lot of value. Jordan, my friends at crushthestreet.com have just released a major documentary about the student loan phenomenon.
Yes.
There's an insane amount of debt owed, which is like an overhanging cloud above these young people who wanted to get an education so they can start their way in the business world or become a valuable part of society and the workforce. And I know you have figured out strategies to counteract this mind-boggling debt cloud that is just paralyzing a lot of young people. Could please explain?
Just to give you the idea, there's currently $1.4 trillion in student loan debt outstanding. The average person graduates with $38,000 in debt. That's the average. Many people, $50,000, $100,000, $150,000 undergraduate alone. Then you go to graduate school, business school, law school, dentistry school. 200, 300, 400,000 on top of that before you get your first job. And this is just crushing to an awful lot of people. And the result is over 50% of the people graduating from college are going back and living at home again because they can't afford to buy homes and cars and rent apartments because they're spending all their money that they're earning, whatever they're earning, on their student loans. So it is changing society in a negative way and getting people later and later to start families and kind of get out in the world because they've got this huge burden of student loans. So yes, it's a huge problem. I did a book on this last year called The Ultimate Guide to Student Loans. People can get it at Amazon.com. And it is a huge problem. So let me give some solutions. I can't make it magically disappear. That would be nice. But I can at least give some help to get it under control a little bit. The first thing is you can consolidate your student loans. If you've got a whole bunch of different loans at different interest rates all over the place, you can consolidate them into one and save yourself money and get a lower interest rate. A website for that would be consolidatecollege.com. They've helped a lot of people do that. It can be kind of complicated, so they can help you figure out, even if you're a delinquent or getting your paycheck garnished, or you're in trouble, they can still kind of work it out. So that's the first thing, is consolidate it. And the second thing is, a lot of people don't realize you can refinance your student loans to much lower interest rates, typically 2 to 3%, something in that range. And there's a place that can help you do that, which is called credible.com. So the website for that is Credible, CREDIBLE, credible.com. And then put /money answers. I know it's me that way. You get $200 off your first payment if they get your loan there. And they've also got a phone number, 855-870. Now, Credible has about 8 different lenders who will refinance your student loans. So it's not just one. You kind of compare all the different possibilities and do what's best for you based on your credit, the amount you've got, and so on. So you combine federal loans, private loans, all these into one at a much lower interest rate and pay it off quicker. So those are 2 solutions that can help people. You just can't make these student loans disappear, but paying them off quicker is a better thing.
Yeah, definitely. Look, you're giving us like a treasure for people who are, everyone knows someone who is who has a student loan situation. So this was amazing. I want to switch gears, and
Sure.
Jordan, the market is absolutely euphoric about Trump. Tax cutbacks, deregulation, increasing on defense, and infrastructure revolution. These key points have sent stocks roaring and soaring since Elections Day. And I, for one, am very selective with new investments. We just released a new wealth stock on wealthresearchgroup.com/cash flow, which yields at 8%, and I think will flourish under Trump administration. And I want to get your take on the following sectors, and I want you to just tell me if you're super bullish, moderate, bearish, or don't touch. Okay?
Okay.
So let's start with oil.
Bullish, not super bullish, but bullish. I don't think oil prices are going up that much. I think they're going to be in this $50 to $60 range for quite a while because there's still so much new supply coming on. So they're going to do okay, but we're not going to get back to $100 barrel oil anytime soon. In fact, oil is going to be used less. We have lower electric cars, more efficiency to some extent, and there's still plenty of supply out there. I mean, OPEC cut back on production recently, but there's just too much supply. So I would be kind of in the moderate bullish category on energy.
Bonds.
Okay, because interest rates are going to be rising. The Federal Reserve is going to be raising rates probably 3 times this year. Inflation is picking up. So I would not want to be stuck at a 2 or 2.5% yield where you're going to lose a lot more in principal yields. I mean, I mentioned the commercial real estate income funds is a much better way to go for income, where you're getting 8% with no market fluctuation. So I would stay away from bonds.
Sure. Now, let me ask you about Bitcoin.
Very volatile. I'm not sure I would invest too much in it, but there's a reason that people like Bitcoin is they don't trust fiat currencies. So I think the concept of Bitcoin is going to be around. It just as a place to invest also day to day.
Sure. Okay. Now, cash.
Stay away. you know you're going to earn nothing on it. And to stay pretty much near zero. Even when the Fed raises rates on what's called the Fed funds rate, which is what they control, the banks are raising what they're charging on loans, but they're not raising what they're paying on deposits. So it's unfair, but that's the reason the bank stocks have gone up so much. So cash is trash, I guess you might say.
So basically, a better way to save would be gold.
Gold's had somewhat of a move recently. I wouldn't put a huge amount into it, maybe 10%. And instead of physical gold, I'd probably do the exchange traded funds like a GLD or silver, SLV, or even the gold mining shares like a GDX. Well, if you're really willing to go for it, a GDXJ, which is the exchange traded fund for the junior mining companies. And get a diversified portfolio because you never know when a particular gold company is going to not hit gold or have production problems. So 10% of your portfolio. But what's going on right now with Trump and the economy growing, that's where the action is, much more than gold.
Metals.
Bullish, not super bullish, but bullish. Assuming the infrastructure plan goes ahead, a lot more demand for base metals. When you're building roads and bridges and highways and buildings and all these things, that needs commodities of various types. So base metals would be in more demand. I would do that through maybe a exchange traded fund, diversified portfolio of those.
Residential real estate.
Super bullish because the supply-demand situation. We're creating about 2 million in the United States, about 2 million new households per year, but we're only building about 500,000 or 600,000 new homes. And every year homes are being destroyed by floods and hurricanes and fires, and so we're losing some housing stock, and we're not replacing it fast enough to meet the demand from new families coming in.
Interesting. Which states are experiencing this the most?
Florida, Miami is very hot. Texas is very hot. San Francisco is super, super hot. New York is hot. I mean, to some extent it's local, but there's also a lot of foreign money coming into these places like New York and San Francisco. So real estate is doing very well. If you're going to buy it as a place to live, that's fine. I wouldn't buy it as a way to speculate to make money because that's dangerous. If you're buying it as rental real estate, make sure it's positive cash flow. You don't want to be buying it and your costs for insurance and mortgages and so on is going to be more than your income, hoping to be bailed out by appreciation. That's when people get into trouble, when they spend too much, the price is too high on commercial and residential rental real estate.
Cutting edge science for the aging population, the healthcare industry, and those smaller size companies that are working on cutting edge science.
Super bullish. We have about 72 million baby boomers, and every year they get older, they need more healthcare in various ways. Now they're living a lot longer because of these healthcare discoveries in various ways. So yeah, I think that would be a very good place to invest. Again, I would do it through a mutual fund that's going to do a diversified portfolio because any individual drug or individual medical device may or may not work, but a diversified portfolio could do very well. And specifically, biotechnology. Lots of innovation going on there. My exchange traded fund favorite would be IBB, which is Diversified Portfolio of Biotech Drugs. One of the new things that's going to happen that's going to help that area is there's going to be a new Federal Drug Administration or Food and Drug Administration official who's going to speed up the approval of drugs. They've been taking forever, and he's going to speed that up. So these biotech companies are going to get their drugs on the market much faster, which is going to help them.
Excellent. Lastly, marijuana legalization.
Super bullish because it's just beginning. I mean, we've had, in the latest election, I forgot, there were 8 states, I think, something like that legalized it. I think we're up to 20 states in the United States that now have it legalized, a lot of them just for medical marijuana, but more and more for recreational, including places like California and Washington and Oregon and Colorado and all kinds of other places. So the demand is going to go. We know it works. We know it helps. We know people are already smoking and eating it in various ways with cookies and candy. So the demand is huge. Going to be some volatility there, but yes, in the long run, I think I would be super bullish.
Jordan, before you wrap this up, is there any? I'm very curious. Is there anything you're super bullish on?
I mean, biotech is the must. I'd say the super bullish because you've got fundamental growth there. The only other area I would say would be the technology companies, the big ones, Amazon, Google, Salesforce.com. Those kind of companies have huge potential. Netflix, NVIDIA would be one of my favorites as well. Those are some of the stocks that have done really, really well, and I think they have huge potential to do even better.
Jordan, I've had a great time with you here, and you've added value to anyone listening. Could you plug listeners in to various websites and your books, and quickly share where people can get more details about what you do, and kind of specify the different themes that you specialize in?
So my website is moneyanswers.com. You'll see on there all kinds of resources about all aspects of personal finance. Mortgages and credit cards and investing and real estate and insurance. And, this is what I've been doing for a long, long time. I give speeches to various groups. Love to do that kind of thing. I've got a blog. I have a show myself, which is called the Money Answers Radio Show, which I've been doing for 10 years. Weekly, there's a link to that at moneyanswers.com. So I just love to help people. Just look at what we've done in our time together here, Lior. We've helped people earn 8% instead of 0% on their money. We've helped them pay their mortgage off in 5 years instead of 30 years on the same level of income. We've helped them pay down their student loan debt faster. We've given them some great investment ideas. These are things I think can help a lot of people. And many people don't have financial advisors giving them this kind of advice. So it's really great they're listening to your podcast, and hopefully I've been able to help a little bit. I'm glad to help them at moneyanswers.com.
Jordan Goodman, moneyanswers.com. Great to have you on. Thank you very much.
Thanks so much, Lior.
Jordan Goodman is a walking investment and financial encyclopedia. We'll definitely have him on again many times more, as he's such a value added for listeners. If you haven't already joined, Wealth Research Group was ranked 2016's most important free financial newsletter, and we've just released a new wealth stock on our classic issues page on the website. Jordan Goodman talked about a great strategy for slashing a 30-year mortgage into a 5 to 7 year mortgage. Make sure you're a subscriber, as we release a members-only 4-part real estate series about the 4 major profit pillars, and I'm most excited about the upcoming one that will be published in late March, as it deals with quick 2 to 4 week deals, zero money down, $3,000 to $5,000 potential profits each deal. I used to do those myself, and I'm thrilled to share this strategy. Jordan also talked about the fact that he knows the subject of student loan bubble, up close and personal. Our friends at crushthestreet.com have produced an important micro documentary about the college debt mess, and you should definitely take a look at it. Finally, Jordan took my bullish bearish scale that I always ask at the end of the interview, and suggested investors buy ETFs instead of individual mining shares. That is a sound idea if you are not going to research specific companies. If you are, Wealth Research Group has just profiled our top Cobalt company for 2017, and you should definitely go to wealthresearchgroup.com/Cobalt, COBALT. Join us, as we'll have many more great interviews in the coming weeks, and we got the sovereign man Simon Black and some great Bitcoin interviews. So see you next week.